Welcome to Power Charting. I am your host, Bruce Frazier. This episode is originally airing on December 1st. 2023 is almost completely in the bag. It's been an incredible year from a financial market perspective. We have been here through the whole thing. I very much appreciate your involvement, your following along, your being Wyckofians, and I look forward to more of this in 2024. Last year at this time and in 2022, we created a roadmap for the year ahead. That is what we're going to do today. This is going to be a relatively short episode, and we are running out of year. So actually the month of December zooms right by because of the holidays. And we are going to try to fit in one more power charting in the month of December. But in the meantime, I'd like to end this episode on a crescendo with a couple of really interesting charts and leave you with an idea for how 2024 might unfold. And we will do more of this in the future, I'm sure, but just something for you to think about. And with that, let's get started. I have a very special announcement. This is going to be a treat for all of us. TSAA-SF is going to have Jeffrey Kennedy as a special guest at our virtual monthly gathering Tuesday, December 5th, 5 to 6 p.m. Jeff is a great friend of the TSAA-SF, and we would like for you to attend. These are going to be member-only events in the future, but this one's going to be open to all. And the TSAA is just a great organization. I've been a member for over 40 years, and it's just enriched me so much. It's a great place for all people that are technical analysts, charting enthusiasts, and we have much, much more ahead. So please stay in touch. Let me show you how you can receive notification for this event. And I want to show you, this is the website, TSAASF.org. All you have to do to be able to sign up for this event is go to membership. And when you're in membership, you'll see mailing list free. Click on that, go to next, and just all you do is put in an email. Don't share your email with anybody. It's just for internal for our community, and also to notify you of upcoming events. Become a member, and we're going to have a raucous good time in 2024. So please consider membership. But in the meantime, come. Jeff is going to talk to us about all things Elliott Wave. It's going to be a very informal event, very exciting. He's going to answer attendees' questions about stocks, about indexes, about futures, about Elliott Wave. And Jeff is just such a friend of the organization. You will really have a good time at this event. So please sign up and attend. And if you have any questions, go to contact us, and there's an email there where you can contact the administrator. And with that, let's get started. We have a lot to do here. So moving on, you saw this chart 2 weeks ago. When we last met, we didn't meet over the Thanksgiving week. You can see that the S&P ran back up. Let me get my pen going here. And okay, so you can see we came back up into the channel on the S&P 500 after declining out of it into an oversold condition off of this downtrending channel from July. It went right to very important old resistance, new support that impacted and affected the market going all the way back into 2022. And now it's pushing up. Let's see what's happened. Part of the reason is that I show you this chart again, you've seen it before, we actually have documented in real time the events of the bear market, which were very well established. We talked about them here in power charting, And you can go back and look at those episodes from a year or more ago. Great point figure work, etc. But let us talk here about the potential for what could happen in the next month or two. And I would like to emphasize that very important, this chart has the quarter end effect. Very, very few people really pay attention to the quarter, the effect of the quarter on the financial markets. We talk about it incessantly. I apologize to you for that, but the quarter end, the year end effect is remarkably important. And let me clean up this chart and show you why. Look, this is the end of the year 2021. The high of the bull market clocks in right on the end of the year. That is not an accident. You have institutional investors pushing up prices in these markets into the highs because they want to, they're effectively window dressing their portfolios into the end of the year. And it happens all the time, very much a part of the Wall Street persona. And here you can see with these quarter ends that highs and lows tend to nest around them. Year ends are even doubly important. So here, this looks, it's an important low, the end of 2022, year end, but I'm going to show you in a minute why this is even a more important low than it looks like, because it goes right down to the support as defined by the preliminary support level, and the selling climax slightly goes through it and then it rallies sharply. This is the beginning of accumulation through here, and we talked about it a lot, so I won't go into it here. But let me point out that here is the end of the year. And the end of the year, we're going to watch very closely as the market pushes up. And this really is the emphasis of this episode. This chart is through today, November 30th, not through the close. Additional weakness since this time that I printed this chart up. But you can see quarter and year end is coming here at the end of December, as we all know. And look at the market like a heat-seeking missile pushing right up into the highs. Not an accident. The institutions are in here buying these stocks. And let me just point out a couple of interesting things. As of yesterday, the S&P 500 for the year, according to my calculation, was up 18.5%. Darn good year. And so this, as we see, this is from the low that was set at the end of 22 to this recent high, very close to the high that was set in July. It could go higher, and we'll talk about that more in a minute. But also, we're going to look at the NDX and the NASDAQ 100 and those Magnificent Seven type growth stocks, because they were up much, much more. And these growth stocks are what pushed up the S&P 500. If you just do an equal weighted index of the S&P 500 instead of capitalization weighted, which you can look at, it's called the symbol is RSP. It is an ETF of the equal weighted positions in the S&P 500. The return through yesterday was 5.5%. So 18.5% if it's capitalization weighted, 5.5% if it's all equal weighted. Most institutional portfolio managers have some tilting towards cap weighting, but nothing like the indexes, I would say. Some do, many don't. And so their returns are lagging. And they're not just lagging the S&P, but they're massively lagging the NASDAQ 100 index. And I will show you more in a minute. But they are putting cash to work, rearranging their portfolios into year end. The year end effect is at work, and typically it clocks in somewhere between 2 to 3 weeks before the end of the quarter to 2 to 3 weeks after. So I expect that at the opening bell of 2023, the market was on its lows, near its lows, and at the end of 2023, the market is going to be near its highs. This is the effect of the institutions selling at the end of 22 and buying at the end of 23. Phenomenal event, but very important and something for us to always keep in mind. Okay, so now look, here is the resistance zone. This resistance zone is defined by the high of this upthrust and the preliminary supply point, which is where selling came in earnest in the distributional top of 2021. So we're just saying that this is about where supply is going to be present. This could slow the advance, could stop the advance. It may not stop it until it gets to the highs of 2021, which is right here, year-end effect. And so we can see here that resistance is at work, and this may slow the advance. We'll talk more about that in a minute. Okay, here is the NASDAQ 100, the $ NDX at StockCharts. This has been my documentation of this, and so that I could keep track. I have under this chart two indicators. This is the NASDAQ 100 stocks above their 50-day moving average, and the bottom one is the NASDAQ composite, the entire composite number of stocks above their 50-day moving average. These are breadth indicators. We talk about them all the time. We look for overbought, oversold. We look for divergent characteristics, and we look for directionality in these indicators, which we've talked about a lot. We did talk about the fact that into these lows here, that we had an oversold condition and we had a positive divergence, and you can see it right here. There's a really good one through here, and a kind of a smaller one here, and a lower low here to here. This is internal repair of the market. We look for that, and then we look for the directionality to point that the new trend reversal is in force and acting. And look at how beautifully that worked. And we do this over and over and over. I've been doing this for, gosh, nearly 40 years. And I would love for you Wyckofians to be able to see this wonderful breadth work and use it for your own benefit. So that's why we talk about it a lot. And so you can see also that the rally here in the NASDAQ 100 has not yet gotten back up into the channel, but it is into the resistance zone, which is the highs that were made in July. Notice how this July high in the resistance zone created a correction. Another push up here is actually a positive, because that push up into the resistance zone is continuing to absorb the overhead supply, which is what needs to happen to continue the uptrend. And so we will look for the characteristics of that, and then also be aware of the potential for any kind of a correction, reversal back down. And you can see that we are now overbought on these indicators, but we are not diverging yet. And my view of these are, as long as they're pointing up, and making higher highs, that this is a sign that the market is going to continue to go in the upward direction. We watch for reversals and then divergences and then downtrends to show us the change of these trends. But for the moment, we generally have higher and higher prints in these indicators, these breadth indicators. This suggests that the market still has a northward direction to it. Now, that can change quickly, and that's the reason you need to be looking at these on a regular basis. I'm going to show you the New York in just a minute. Let's see, is there anything else I wanted to cover in this? Oh, yeah, the other thing, very important, look at how deeply the correction was at the beginning of 2023 in the NASDAQ 100. It went all the way down through the support area, weaker than the S&P 500 at that time. Did not make a new low, made a higher low, and then look at the positive characteristic internally and look at this. Look at the low here and then the low here. How much higher it is. This is it's an in-gear relationship, but this is acting much better, the internals, than the index itself. That is a huge clue. We talked about it at the time, and that was a huge clue that the institutions were throwing these stocks overboard. They were getting out of these exceptional names that were going to be the leaders of 2023. The return of the NASDAQ 100, that index, capitalization weighted, but they're all the big growth stocks. Remember, the S&P 500 through yesterday, midday, 18.5% through the year. That was my calculation. And the NDX 100, according to my calculation, in case, I get these things wrong occasionally, up 46%, 46% for the NASDAQ 100. Just an exceptional year. Quite amazing. These institutions were throwing these stocks overboard at the end of 2022 while they were window dressing their portfolios. And they were completely out of step with what happened in 2023. This is a large accumulation structure, and we have done point and figure work on this. We've documented it as it unfolded, and 2023 was a great year because of our Wyckoff technique, methodology, and trading. And so what a great year. And we all did this together through the course of the year. And I'm glad you were here. So here we are at the end of 2023, and the market is pushing up and trying to make a final high into the end of the year. Can it close at a new all-time high? I don't know. Can it close while it's pushing higher into the end of the month? It entirely could. So it is into the resistance area. It is into supply zone. And with that, we'll just keep that in mind. And I'm going to show you another chart in a minute so that you can keep track yourself. Now, let's focus on the chart on the right. We looked at the one on the left. This is the NASDAQ composite stocks above their 50-day. Here is the New York stocks above their 50-day. I want to make one point here. Again, well, a couple. One is that we just keep making higher highs here, which again confirms the trend. And so as long as this is going up, it's now 73%. 73% of New York stocks are above their 50-day average. That's a very constructive situation because it was at 15 just at the beginning of November. Just this month, it's gone from 15% to 73. That's a heck of a rally, and it continues to point higher. So we will keep an eye on this. Yes, it can top out and reverse direction, and we will definitely be aware of that, and we will look for divergence and so on. But what the key point I would make here as this market is rallying and pushing up is that the market's broadening out. Remember how narrow the market was in 23. The NASDAQ 100 was up 46%. The average S&P stock was up 5.5%. And so we want to see the market broaden out because that's a sign of the market becoming internally healthier. So we will be looking for this. This is an element of that. These charts pushing up towards an overbought condition. We love to see this indicator become overbought and then stay overbought. And the more overbought it becomes as this rally goes on, I think the better, because it shows the internal breadth is quite strong and exceptionally good. Now, let's turn our attention briefly, because I promised to make this a short episode, and I'm not going to do it, this is the gold miners. We talk about the gold miners from time to time, and I want to show you these are swing trading counts. This is a one box reversal method, traditional scaling. This green box here shows an accumulation structure with a sign of strength, a backup to where it broke out, and then it rallies again to another sign of strength here, and then comes down for a pullback again to old support and holds there and gives us another swing count. Something important that happened yesterday is that we were able to get above this resistance area at 30 and we went to 31. Now that may mean that at 31.32 it needs to pause and build potentially more count if it's going to go higher. Doesn't have to, but this count that we have here goes 39 to 41 and here, and note that this huge count goes 40 to 45, and at a later date I will show you that there's even a bigger count than that. But the thing that I want to emphasize is that we're starting to see strength from the gold miners and from gold, from silver. I'm going to show you silver in a minute, and things are pretty healthy here. So, but what has to happen now is that after a potential pause is we need to rally up to these old highs at 36. Then we need to rally up to our initial count and then potentially get up to these higher counts to be able to again confirm these counts are good. And as of now, it's still in the structure, so we got to be careful. Here's the dollar. This is UUP, which is our ETF proxy for the dollar. 60-minute chart intraday. This just points out that Wyckoff is fractal. It's a beautiful structure. This is the reason I did a 60-minute chart, is I want you to see the detail here. And look at this beautiful distribution structure. Climactic event right here. And then it goes into a range-bound condition. It up thrusts at the conclusion at 30.15. Now remember, dollar is going to be much less volatile than, say, a stock. So the scaling here is only 0.05 for the point figure, which was calculated using ATR scaling. But when it broke down out of the structure, look at this big sign of weakness decline right there, and then it rallies up into the structure, gets up to preliminary supply, or call it the climax, and then just fails very sharply out of that. Now we have a count that goes 27.90 to 27.60. So that is not a big move for a stock. It is a reasonably big move for the dollar, taking it back down into this zone right here. So very interesting for us to watch. I believe this is part of the reason that gold is rallying. It's also a function of the fact that interest rates are falling. So there's no longer this demand from overseas to buy our coupons, our treasuries, and our corporates at these higher yields. And so as yields come back down, demand is diminishing from foreigners for bonds. And so with that, the dollar is pulling back some, and it's causing other asset classes, and may very well be the reason for the breadth, constructive breadth activity in the broad market. Here is the silver miners. Silver miners are a little weaker looking, and you can see that they pulled back down into the support zone around 24.25 and are attempting to reverse here. This is through yesterday. This little swing count goes to 35, and there is a bigger count, and that count goes 53.54, counts over here. I know I can hear you all now. You're saying, well, there might even be a bigger count. Absolutely true. But let's take this one bite at a time. 35 makes sense because of the resistance up here. That would be a sign of strength also. And we will look to see whether the swing count can be fulfilled. Currently, it's around 27.70. And then look from there at how it trades in here for the potential to get to the higher counts. Wanted to show you that. Now let's get to the crescendo. This is the high point of the session. This is what we looked at. We put this chart up in the beginning of 2023. We did the same chart in 2022, but a different seasonality, of course. And we at the time said that the first half of the year into July was going to be the positive bias to the year. And then we were going to have a sideways to down trading area from July into the fourth quarter and then strength into the end of the year. Now, how did that work out? And we looked at this often through the year. So here is the S&P overlaid to this, and you can see there's a huge family resemblance here. Strength at the beginning of the year, then a pause or correction into March, end of the first quarter, rally into July, end of the second quarter, start of the third. And you can see that the seasonality was in gear pretty much with all of this. Now, you don't trade off of seasonality. We trade off our Wyckoff tape reading skills, but we can confirm or deny the seasonality with our chart reading. And so with that, we can see that there was a downward bias into October, clocked in the low. Look at the seasonality and look at the low in October. They almost were spot on time wise. And then the rally started, but the rally's been much stronger here than it was from October to November in the seasonality. And then we have strength into the end of the year, and very well could have an upward tilt to the market into the end of the year, and maybe even potentially a new high above the 2021 bull market peak. We will have to wait and see. We talked about the resistance, the overhead supply that exists up here may come into play, but nonetheless, it's already been an exceptional year, as we pointed out from the performance numbers that we have here in late November. Okay, so now you're all asking the question, what does the seasonality look like for 2024? This is our roadmap for the year ahead. And so I'm going to show this to you. Thank you much to Seasonax, Seasonx.com, for letting us use their seasonality tool to create these charts. Let me tell you, this is 1949 to the present. Well, actually, yeah, well, through the end of 23. And this is for the year ahead for 24 as a roadmap, is that what we have been doing with our seasonality is we've been looking at it relative to the election cycle. We said in 23 that the Fed was likely going to finish their rate hike cycle in 23 because they don't want to do anything in 24. And now there's even the potential percentage-wise for a decline in rates at some point in 2024. It's not better than 50%, it's less than 50%, but as time goes on, there's actually the potential for a rate cut. I think the Fed would like to just do nothing in 24 because it's an election season. They don't want to appear to be political. But here is what the presidential election years going back to 1949 have looked like when they're all combined together into a seasonality chart. You can see that we have strength into the end of 2023, which was on the prior slide. And now we can see that 2024 into March is sideways with weakness into the end of the quarter. And not severe, very dull, quiet market. That kind of makes sense because there's supply up here. It pushes up into the end of the year. Institutions push forward their demand into 23 because they want to be show that they're fully invested, and then they use up cash not available to them in 24 when the year starts. And so that makes sense that the market would just stall up here, especially if it intends to go higher, as seasonality suggests for 24. So from mid-March until August, September, we have an uptrend. And you can see here, this is the return by month through the course of those months. And so there is a great window. We will look for confirmation from our tape reading and from chart reading of the potential for this to happen. But an uptrend from March to September would be something we would definitely want to participate in. May not be as big, vibrant as was the rally phase in 23, but there may be other sectors and indexes that do well. I'm noticing the Dow is coming to life. I'm noticing the Russell is attempting to come to life. That's part of the broadening out. So there may be themes going on that now have been relatively nascent and out of favor that are going to kick in 2024 during this trending environment. And these trends could start at the beginning of the year. So there's definitely the potential. So an uptrend is defined by seasonality. We will see whether or not that can happen. And then starting in September into October, there's a correction prior to the November election. And this period ends with a late October low and then strength into the election and into the end of the year. So doesn't have to happen like this. Seasonality is something that you can't really trade on it. You got to trade on the charts, but it can give us a sense and a feel for how things can unfold. And in 22 and 23, these seasonality charts served us very, very well. So go check out seasonax.com. They're great friends of power charting, and they have a great tool. And then we will keep looking at this through the course of the year as we did the last 2 years. And with that, that is it. That's the program. I hope to get another power charting in 23 in the month of December. I so much appreciate you all and your attending these sessions and your great feedback. And we will see you in the future. And take care, everyone. Have a great holiday season.